Welcome to EAGTAX and our tax advent calendar, where we will be sharing tax tips and explanations in the lead up to Christmas. For day 21, we will take a look at inheritance tax and the valuation mechanics. The starting point for the valuation of assets on death is that their open market value must be used. The tax legislation specifically states that the price shall not be assumed to be reduced on the grounds that the whole property is to be placed on the market at one and the same time. In plain English, it cannot be a bulk asset fire sale price. For business assets, it is worth obtaining a valuation from the accountants who prepare the financial statements, so long as they are suitably qualified and experienced. At this time, a review can be undertaken to determine whether any inheritance tax reliefs are available, noting any restrictions. There are some unique valuation rules. Firstly, the related property rule, which takes account of assets held by a spouse or civil partner, and if the value of an asset is lower than the proportionate aggregated value, this higher value must be used. The most common scenario is where a set of assets have been divided and unlisted company shares. Some charitable and political party transfers can also be caught by this rule. Where property is owned jointly but not between spouses, the valuer will invariably apply a 10 to 15% discount to reflect the difficulty of passing on a part interest in an asset. Quoted shares are also valued differently. The valuation is the lower of the result under the quarter-up rule and the mid-bargain method. If the death occurs on a non-work day, the executors can either look back to the last working day or forward to the following working day for these cum dividend valuations. Unit trusts are based upon the bid price on the last working day before death, if it occurred on a non-business day. Foreign property must be valued in the local currency and then converted into sterling at the London buying rate. If an overseas IHT equivalent has been suffered, some or all of this will be offset against the UK charge. The cost of administering or realising overseas property can be deducted from the estate, up to a maximum of 5% of the foreign property's value. There are a couple of post-mortem reliefs for lifetime assets which became chargeable and have fallen in value since the gift, and where the executors sell certain assets at a loss. Whilst the recipient of assets gets a bump in their tax costs to the value used for IHT purposes, it should be noted that where the value is not ascertained, it can still be challenged by HMRC. It is always advisable to save any valuation reports and IHT forms as evidence of your tax cost. We hope you found this valuation chat useful. Please take a look at our website for more information and contact details at eagtax.co.uk.